And there are so many businesses that did do well during those years and that aren't doing well now. So you really need to look at that. Did it peak because of there?
Right.
And throw that in valuation. If you're looking at 5-year history and clearly the last two have been declining and they were, they were fantastic in 2022, 21. Nope. There was a reason they were fantastic because there was $3 trillion out there.
Welcome back.
Hello.
The last episode we talked about should you buy or build, and we kind of, agreed that looking at buying a business is probably a good idea at this point where we're at in our economy. I mean, if you got a unique idea, go for it. But if we're looking at buying now on this side, I want to talk about what should you look for? Like, what are some of the major kind of factors you should look for when you're buying a business? I think that there's more than we can talk about in one episode, but you want to look at the business's financials first and foremost, because you have to know, is it making money and can it make money for you, and will it return on your investment and all those things. But you also have to look at the current team they have in place,
years of employment
to the degree you can look at that and not disrupt. You want to look at the assets they have on their books, and opportunities to grow. What are the opportunities for you to take this business and do something more with it? So let's start with financials. We don't have to go through everything, but I think that's a pretty solid one to cover.
Yes. And, over the years doing commercial lending, and when you're having that, I guess, interview process, when somebody's saying, hey, I want to borrow money, and you start telling about so many times, what they say, and then the actual financials never coincide.
Yeah. Right.
You're pleasantly surprised sometimes, but a lot of times I gross this, and tax returns, and it's not even, anywhere near that. And you're like, okay. Mm-hmm. But in general, consistency on tax returns. You're looking to buy a business. Businesses typically have some consistency. If they've already been in business for a while, that's what you want to look at. Okay, look at the gross sales. Where did it come from? Who's the primary driver for that?
Yeah.
Was it because they're, spending money on advertising? You had a direct correlation to advertising for this year and there. Well, in that case, then you don't have value on the brand or history, because if sales are having to drive and it's sustainable, you're not rebuilding, then,
you're locked into ads.
Correct. Yeah. Then, there's not as much value on other things that you would put in, because,
that's a good point. Yeah.
Businesses, you've got value that is not tangible, that you can't see. And that would go into reputation. That would be how well they've got their procedures and policies and things locked down, and consistency.
Yeah. On reputation, an easy one, just look on Google, look at all the review sites and see what people are saying. If it's 5-star through the roof, then
it's a good start.
That's good, But if it's like a lot of 1 stars, there's a reason.
Mm-hmm.
Yeah.
And so,
but then systems and processes is the other side of the story.
Correct.
If they have procedures in place, then that's a great, green flag.
Yeah. So there's going to be things that you can add value into that, and others you can take away. And depending on the business, you have to look, okay, great. You'll have an owner, and maybe they're paying themselves, a salary greater than somebody else could be doing their job. Well, great. They're going to have value to you. Or maybe they're, paying themselves undervalue, and they're really the most integral driving force behind it. Yeah. So that's great. They built a wonderful, successful company, but as far as value without them, that's an unknown.
It's going to be hard.
That's an unknown.
It's going to be an uphill battle. I mean, it's a big red flag. It's just no way around it. It's not one of these where you're like, well, maybe we can make that work. It's like, no, it's not going to work.
Yeah.
It's just not.
And so, on those unknowns, then there's going to be, do you base your valuation on, because something's going to happen. You don't know what, but in none of those unknowns, they're not going to, you're just going to be surprised. Regardless of what you think is going to happen, you're just going to be surprised. You could be pleasantly surprised one way or another, but you need to give yourself room there, because there's going to be surprises.
Yeah. I think internally and externally, looking at the market, looking at, a good benchmark is how did this business do through COVID, and were they affected? Okay. That's a big external threat of types that could happen again.
And there are so many businesses that did do well during those years and that aren't doing well now. So you really need to look at that. Did it peak because of there?
Right.
And
That's
throw
right.
that in valuation. If you're looking at 5-year history, and clearly the last two have been declining, and they were they were fantastic in 2022, 21. Nope. There was a reason they were fantastic, because there was $3 trillion out there.
And now that's waning. Well, and that money's going away.
Well, a lot of that, you had a considerable amount of fraud. So you had money in hands of people that had now purchasing power that are not the same purchasing power of people that have made it from their business.
Mm-hmm.
There's two different things. When people get money that it wasn't something they generated on their own, they spend it completely different than if they had generated from their own work.
Yes.
I've seen it all day long, going back to 2009 when I had foreclosures. Preceding that 2009 and going in, values of real estate increased so much. And so people had equity, and a lot of their down payments on properties were from the sale of a previous property that just happened to escalate.
Mm-hmm.
So they were taking the sell and escalation of property, which was great. They'd earned that because they happened to own a piece of property, but now they were taking that and buying something that then involved maybe a business or something else. Mm-hmm. And so just because they had a great down payment because they sold a piece of property, how did they earn that? They didn't really have to run a business, and now they're buying a business with it down.
Yeah,
it's going to go downhill because the way they generated that net income had nothing to do with what they were future doing.
Yes.
And it was a one-time event.
Yes.
They weren't going to be able to go back to that well ever again.
Yeah, it makes me think of the value investing philosophy, Buffett, or I can't remember the guy he got it from, but you're not looking at the stock price as much as you're looking at the value that the company is worth and how it's doing, on its books. That's kind of what it makes me think of. Is it actually value and have its own integrity? Or is it some outside force that happened that is not you can't replicate?
Correct.
Yeah. So if we looked at a financial statement, what would be the first place you'd go? What's the first thing you're going to look at?
Forget their financial statements. Just get the tax returns.
Okay.
Get the tax returns, because that's the first thing. What are they after sales? Because if you're buying a business, you got to see what they're telling the truth on. And there, so many times, I got 2 sets of books. People do all that shit.
Yeah.
You need to only pay for the value of what is related on the tax returns. That's the only thing review. Now, if you're stale dated and their internal numbers of their, profit and loss statement matches each year, their tax returns, then you have got great honesties from that seller.
Okay.
But so many times you'll see, here's my net income. And then you get the tax returns, and the tax returns may show less taxable income because of depreciation and things like that were, taxable. They didn't take away from cash flow.
Yeah.
But so many times I've seen the net income and it was like, okay, well, the gross sales aren't even reflecting here. Oh, but I can trust you over here and what you wrote down, but not on the now.
Right. Right.
So,
okay, that's interesting.
Go straight to the tax returns.
Yeah, I like that.
And then go from there. So you ask for tax returns, and they're internally prepared at the same time and coincide, see what they're making sense of.
Yeah.
And so that right there will give you a buffer of, now we're in 2025. People haven't filed tax returns yet. They may not file the April 15th. They're going to hold out. Somebody doesn't, they wait last minute, or they're going to file an extension October.
Yeah.
So then what did they do in all 2024? Mm-hmm. Well, you don't have tax returns. You don't know what they actually are selling their accountant, and their accountant is saying, here is, because they're probably not audited financials.
Right.
The CPA is going to put on whatever was handed to them. Mm-hmm. They don't know 100% of their business.
Right. So what I'm hearing is go to the net income first.
Sales, net income. Yes.
Okay. And then from there, where would you go? Are you looking at debt next or no?
Oh, yeah. So that's going to take in the debt, but then look at their internally prepared numbers, see how those coincide, see if there's going up to right then and there. That's going to then paint the picture of to the accuracy of how you can accept everything else. Because everything else is going to be like internally prepared. If you know, if it's okay, a percentage of your customers are here, now you got to build the trust. Now, okay, if those things don't line up when you're, trust me, the margin's over here. no, I don't trust you. The numbers on your internally prepared and your tax returns don't match. So I don't trust anything. I need to see proof.
Right. Okay. Okay. So then how would you assess debt when you're looking at, their debt load? Do you just go on a percentage? Like, or
it depends on what is a relationship for the debt. So what do they have debt on? Is it unsecured? Mm-hmm. Do they have debt tied to are they using debt in inventory? Mm-hmm. How are they using that debt? Was it to buy equipment? Okay, great. They bought equipment. If it's equipment, then that's a quick, easy one. What is the piece of equipment? What's the useful life of that equipment? Mm-hmm. You're going to have to rebuy that in 5 years. Okay. Is that debt, going to be paid off within 5 years of that useful life, or do they get debt and it's a 15-year amortization?
Yeah.
And so now you've basically have paid off that equipment and go from there. So yeah, you need to know kind of the debt.
And that gives you a window into the why question of, okay, they've got debt for this equipment. Look at the cycle. Why is that cycle? Is it just mismanagement, or is it good management, or is it that they are utilizing this equipment in the wrong way?
Yeah.
So it will give you a picture into how the business is being run. And if
it does.
It's being run. Yeah. Okay. Any other thing on the financial side? Because I think that's a good place.
You get from there. I think people bog down in the ratios and they get in all these. I've always seen them. I call them swag, silly, wild ass guesses on, where you're going to take it.
Yeah.
And 99% of the time, every time I've seen the budgets and the future things, they're already like, they're thinking that they're going to be triple. It's just like, oh my goodness.
Yeah.
What happens if you don't grow where you're at?
That's
right
the best. Yep.
Can you make it right then and there?
Yep.
What do you do?
And can you cut back, maybe even initially in order to use that as a growth lever first to put you even in a better position?
I think you need to play your worst case scenarios and see how far down it would go to, okay, if 50% of the sales, could I survive?
Yeah.
Yes. Okay, great.
And then
could I go to 75%? No, I'd have to be bankrupt. Okay. Now go in what's the likelihood of this? Yeah. I think play those worst case scenarios in the beginning. Yeah. And then as you're planning out, you look, that's a trigger that could likely happen because, you could have, 10 scenarios that have a 10% risk of going bad. Mm-hmm. So that means one of them's going to go bad.
Yeah, it's true.
You got to plan on it.
Yeah, it's true. It's sort of Murphy's Law or some law. I mean, we see it in sales. On the positive side, if you're prospecting and you have a pipeline full of people, you take that number and there's a percentage of those that are not going to close. So as you're looking forward, it's the same thing. So looking backwards, there's no difference. Mm-hmm. These threats are going to come.
Yeah. And especially too, if the business you're buying, if the person that is generating the sales and the ongoing support is ultimately leaving, then obviously it's
a big gap to fill.
Yeah. Take consideration. How are you going to fill that gap? Mm-hmm. Do you know?
There might be key employees that can step into it.
Correct.
That's another thing is, do you have key employees? What's their, longevity at the company? Is this person, I was talking to somebody the other day and they had one of their like top engineers who basically knew everything died, and they went into kind of a tailspin, and so they brought in this outside AI firm, and it would be a really interesting conversation actually to talk about. But this company came in and created sort of what they did was they took all of his emails, all of his proposals, all of his, anything that he had ever documented or talked or done anything, and they fed it into a LLM. And they said, okay, and then they named it his name. It was Ask PR or whatever his initials were. That's the name of the assistant. So they were able to sort of almost completely replicate him as a person with this AI tool.
Wow.
And so they were able to keep running because he had all the knowledge. But that's pretty creative, right?
That was.
I would say most companies.
Talk about succession planning.
I think most companies, you need to look for, okay, the business owner may not be.
So then my question is how do we get AI into here, and then in the meantime require everybody to constantly feed the AI.
Make everybody better. Lifts all boats. Yeah.
Yeah. Your positions and your stuff. So then you're coming in but that is scary. So you got to have the right mindset of employees. Cause you know,
it's right. Cause there's a lot of companies out there,
but I've had great employees that they're so afraid they learn what they learn and they don't want to add anything else to it. And somehow, and it's weird. Sometimes you'll see people get in that box when they're in their 20s, 30s, 40s, 50s. And it's not like, they're all going to hit it when they're 10 years in a career, 20 careers.
There's no way.
They hit it at different times. It is
I think it's a personality thing.
That definitely, I've seen some characteristics that carry on that.
People get stuck in their ways. And if they're a certain type of personality, you're not going to change them. It takes a catastrophic event for them to wake up and change.
Yeah.
Unfortunately, but all right, this is good. I think we can come back to this topic and uncover some more things like looking at systems and processes, looking at the market for demand and feedback from the market. There's so much to consider when you're buying a business that this has been hugely valuable from a financial standpoint, because I never really thought about it that way. Like, let's reconcile these two numbers and then it's like you could do that, not spend very much time.
Yeah.
And then you got a big green flag or a red flag and you move or you don't.
Yeah. Now, I swear, over the years, some of the things, you always look at characteristics when, an event goes wrong or, idea. You lend money, you just want it to pay recurring each month and, to the life longer. But, that doesn't happen. There's going to be certain just go out and what makes some go bad and, not. And, I think a lot of it, I've seen the ones that have over the years that I haven't had issues up, they've had their act together. Yeah. That during application on the loans, it was when you asked for something or request, you got it quickly. So it was, it coincides. Yeah. They had their act together. So it's kind of.
Yeah. It makes sense.
Yeah.
Okay, cool. On to the next one.